Hey guys, Stock Saturday, and it's a ever so slightly red week for me. About 1% down, sort of 4,000. Nothing too much. Compared to the S&P, I've done a little bit worse. It's 1.48% up, and the Nasdaq is 0.93% up. So, sort of tech side not doing quite as well. I'm down sort of for a few different reasons. Some of the gold and silver sort of not doing quite so well. TSMC has had a sort of small drop, but I think most of it has just come from fluctuations in the crypto side and the sort of gold and silver side, really. But it is a very sort of, as I say, 1% move on sort of this size portfolio is perfectly normal. And yes, you may have noticed I've bought a new stock. So I've obviously had sort of fairly large cash balance for sort of a couple of weeks now. A little bit more in the ISA side as well, and got to start buying some stuff. So I bought a small position in CME Group. So let's have a look at them now. If you're not aware of what CME Group do, they are an exchange sort of largely for derivatives. So obviously you've got people like Nasdaq, and you can buy Nasdaq, the stock, the exchange, and people like London Stock Exchange Group for sort of the UK side and the analytics side and that sort of thing. But CME Group sort of tends to focus on derivatives and the FX market, as you can see, sort of futures, options on the futures, options themselves, and micro-sized products as well for people who want to sort of hedge and do sort of various things with derivatives, but with a smaller sort of portfolio size. So they offer sort of micro stuff. As you can see, they sort of do futures on interest rates. That's quite a big market for them. You can buy sort of futures on equities or equity indexes rather than just sort of buying the physical for sort of various reasons. People might want to short things and sort of hedge things against their main portfolio. And then sort of futures on the FX market, on energy, agricultural sort of commodities, and precious metals and other commodities. So quite a diverse sort of range of products that they offer. And they note cryptocurrency down here. They don't sort of list it in their section over here, but crypto. They offered sort of CME futures and options on. At the moment, I think just Bitcoin and Ethereum, but they're looking to expand, I would have thought, with the Trump presidency incoming. And yeah, they're sort of seen as maybe the darker side of the crypto industry. Obviously, CME futures launching on Bitcoin sort of pretty much marked the 2017 top. There was more of a liquid market for people to short where there may not have been before. And yeah, I think it's important. People want to sort of use these products, and having this sort of thing just makes it a more mature industry. So yeah, it's basically an exchange that I was sort of intrigued to get into. I sort of like the derivatives aspect of it, and sort of the more focus on commodities. I'm sort of bullish long-term commodities, so futures and options and things all based on that, I think could do well. As I say, looking at their sort of breakdown of revenue, this is average daily volume. They sort of note that interest rates and swaps and those sort of products are the biggest sector, sort of by far, really, and then futures and things on the equity indexes, so SPY, Nasdaq 100 futures, and then your sort of energy and agricultural commodities are a smaller section, but still sort of fairly important, and FX and sort of metals make up a small section. So it is sort of interest rate swaps and the fixed income market. Obviously, the fixed income market is enormous. It's even bigger than the total stock market, so there's no sort of big surprise there. And they're essentially sort of, people call it clipping coupons, basically taking a very small fee off all of this volume. So with increasing volume comes increasing profit. They sort of note volume has been growing at 7% and net profit has been growing at 12%. So they're sort of extracting a little bit more, cutting costs a little bit, putting fees slightly up, and it does quite well. Options sort of increasing, they're noting. Everyone's sort of getting into the 0-day options and sort of more, longer term derivatives as well. People do like options, it seems, sort of more than they used to. They went down a little bit in 2020. I suppose if the sort of world was shutting down, then there was less real activity, and if there's less real activity, there's less need for hedging and that sort of thing. So it's not bulletproof in a recession, obviously. Sort of real activity goes down, then this sort of thing goes down. But yeah, it should still do fairly well. They've got sort of new products in. Obviously, they're noting again the crypto industry. The 3 new metaverse reference rates and all manner of things. Indices for XRP, Internet Computer. Tokens that I'm in. Bitcoin Friday futures. This was like a tiny little product for sort of Joe Public, basically. I'm not sure why they would sort of want to trade futures all that much, but yeah, sort of pushing that sort of thing. Always pushing new sort of base metals and options on micro gold futures, micro platinum, and yeah. On the sort of equity side, small cap, mid cap, S&P, not just the big stuff, and a whole load of stuff, of course, on interest rate swaps and things. But the thing that got me really, really interested, which is sort of fairly unsurprising, I suppose, is the bottom line. They've got sort of futures and options volume here, basically transaction fees on those, cash markets. They also have a bit of a sideline in selling sort of subscription to their market data, and yeah, sort of 5.58 billion in total revenue, but net profit of 3.4 billion. So you're looking at just about sort of 61% net profit, and this isn't sort of a one-off because of like, don't know, some selling a business for a huge profit. This is fairly consistent around sort of 55 to just over 60% net profit. So that's an incredible margin. You've got other sort of companies. There's very few companies that I've seen with that sort of consistent margin. You've got Visa, I think, have always been up there, largely above 50%. As a sort of leading credit card network. Interest and MasterCard are sort of quite a bit below that. You've got Rightmove, who are at sort of 60%, very, very low cost business to run. And not a huge amount else. All of the big techs pretty much top out at 30-35%. Except Nvidia, I think, maybe at the moment are a bit higher, but that's not sort of long-term consistent profit. 2 or 3 years ago they were at fairly low margin. Yeah, and sort of that is about it from what I saw. There aren't a huge amount of companies with anything like this profit margin. So yeah, it is very nice, and you would think sort of even in a down market, people are still wanting to, short the market and buy, puts and things as protection, all sorts of options and futures on the downside. So you do still get some volume, as we saw it. It comes down in something like 2020, but that was a little bit of a different kind of recession. I would think in just an economic downturn where everything's still open, they would still do quite well. Sort of having a look more into their sort of past revenue in previous recessions, but that was a long while ago. They're sort of looking at the 2008 recession. They were quite a different company back then, and the sort of options market was quite different back then. But yeah, it's interesting to have a look into. And what they do with all of this money, basically, is largely dividends from the looks of it. They don't do a huge amount of buybacks. They seem to do sort of a growing quarterly dividend, and they do a variable, they call it a variable annual dividend. So sort of a special dividend at the end of the year based on how much profit they've made. But so you get a constant, quarterly regular dividend rising, but so it can, I guess people will sort of report sometimes a dividend cut, which they would say it technically isn't. It was a special dividend, so you can't count that as regular, but 2019 the total dividends paid were less than 2018, so I would imagine you get those sort of headlines of dividend cuts and that sort of thing with this special dividend model, a little bit like Rio Tinto. They would call it, I expect, a special dividend. But yeah, sort of they seem to largely give most of the money out as dividends. And they're obviously making acquisitions and various things, pushing the sort of market data side. I expect they'll be looking to maybe acquire companies in that area because it's subscription, more of a sort of subscription revenue and less based on just rising volume of their products. But yeah, if they're just dividending out, that's not too bad. But being a US company, I pay sort of withholding tax on that dividend, and I don't have it in the ISA at the moment, so I'll pay dividend tax as well, which isn't ideal, I suppose, but if sort of companies are reinvesting it and I have to sell the stock, then I'm paying capital gains tax anyway. So tax is just the way of life. But yeah, I'm fairly happy with sort of this dividend model. So yeah, overall, I quite like them. I'm sort of looking at a few different financial stocks as well. Was looking at Visa actually as a sort of complement maybe in the sort of financial space. Looking at BlackRock as well. Yeah, sort of not really interested in the banks and insurance side of the sort of financials, but yeah, this sort of thing kind of interests me. Kind of back to considering the REITs as well. I was sort of for a little while thinking of selling off my American Tower and potentially the rest of my Vici. That's sort of quite a small position now, but yeah, as I'm sort of looking to start selling out of crypto sort of over the next 6 to 12 months, possibly be all largely out of crypto by sort of the end of next year, maybe keeping a small allocation. I might be wanting to certainly in the ISA get a little bit more into the REITs, and American Tower has always been one that I've liked. It's a sector that I think has has legs for decades basically, and they seem to sort of be quite well run. They're the largest pretty much in the world in that sector, and yeah, they've sort of not performed all that well. Sort of growth has been a little bit low. You see, I always look at adjusted funds from operations per share. It's at 264, 2.3% growth rate year on year, which isn't particularly good. But yeah, they've sort of had a little bit of a rough time with interest rates and debt sort of interest rate obviously going up. Some of it's fixed, some of it isn't. So yeah, the longer it sort of stays at, even though they're cutting, it's still like a cut from 5.5% to 5% is still very, very high rates. So that does impact profits and funds from operations. Free cash flow up 16%. Obviously, they're still diluting a little bit, so you'd want to see free cash flow per share. But yeah, not too bad results. So there's no getting away from their debt. It's $37 billion. They're not sort of looking to pay it down or anything. They obviously still pay out large amount in dividends, $1.62 for this quarter. That's 750 million in debt, or in distribution. So if they sort of use that to pay off the debt, which they're not really allowed to, it wouldn't even make a dent really. But they sort of focus on their net leverage ratio, 5.2 times, total debt less cash and cash equivalents, compared to adjusted EBITDA. So 5.2 times, that's quite a bit higher than most companies would like to be, but as a REIT, everyone just seems to think that's fine. But yeah, I don't see it as a huge problem if we get interest rates coming down a little bit more, a sort of fair amount more, I would hope. But yeah, less cash. They have barely any cash, so 35 billion in debt is not all that great. But looking at the 2024 outlook, property revenue up 0.7%, so it's not too good. Net income and things don't tend to look at, because that's swayed enormously by depreciation and things. But the AFFO per share, well, I sort of mentioned it was this quarter was 2.6% up. They're looking for the whole of 2024 to be 6.7% up, the sort of midpoint of their guidance. So that's sort of fairly common for them, 6, 7, 8%, sort of sometimes 10% in the good times. Yeah, I sort of think of that as a fairly decent total return. 7% earnings growth with a sort of 2-3% dividend. They're sort of quite a low dividend, but yeah, sort of pushing 8-9% total return, sort of over the long term is pretty good for me. I'm sort of looking for 3 to 4% net withdrawals, sort of 4% rule, but I kind of go 3% because I'm looking to retire early. So that after inflation, this would essentially give me that. Still growing as well, of course. A lot of capex, discretionary capital projects, looking at sort of 800 million or so. This isn't, sustaining capex as sort of the miners would call it. This includes the construction of 1,800 to 2,600 new sites globally, and 480 million of development spend in the data center segment. So pushing more into data centers, which is a little bit strange for sort of what you would think of their business model, but fair enough. And yeah, you got sort of fair amount in redevelopment and capital improvement and that sort of thing. That's more your sustaining capex, but they don't look too bad overall, and not something I'm sort of jumping to get into straight away, but I think probably will be as I sort of sell out more of the crypto. We'll see. So moving on to Pan American Silver, sort of not one that I covered straight away, even though it is a fairly larger position for me, sort of tucked away in the Interactive Brokers ISA, but they do seem to be doing a reasonable amount better than my others, Coeur Mining and Equinox Gold, at least on the sort of fundamental basis. Similar to the others, they sort of had this is September the 30th, 3 months up to September the 30th, so prices have done a little bit better since then. They're sort of noting average realized price of 2,475, so we're up a little bit since then. 29.52 on silver, so we're actually not that much above on that. But yeah, obviously that comes into revenue and net profits. 716 million in revenue on slightly lower production, as sort of most of the others have done. Weather, sort of various things all affecting this. 225,000 ounces of gold compared to 244,000 last year, and silver down from 5.68 million to 5.46 million. Not ideal, they sort of want to be at, you know, 1 million ounces of gold a year, so they would want to be at 250, and they did say 30 million ounces of silver before they made the acquisition, so would want to be at, you know, an average of 7.5 million per quarter, and they're quite a way off that so far, but it's still, you know, producing reasonable numbers. Net profit of 57 million compared to a 20.6 million loss in this quarter last year. There was obviously adjustments from the acquisitions and all sorts of stuff back then, and prices were a lot worse. Sustaining capex of 74 million and non-sustaining capex of 14 million. So that's down from last year's 48 million. So yeah, they're getting into the sort of more just profitable, you know, mine and take the profit period, not sort of a huge amount of capex anymore. The all-in sustaining costs sort of still doing reasonably well as well. Gold 1496 compared to 1451, you know, that's not too bad. Silver 1963 compared to 1819, so that's a little bit higher, but a reasonable amount of profit on those. And breaking that down by mine, they sort of got on the silver side, one in their largest one in Mexico is at 22.25, so a little bit expensive maybe, but Argentina and Peru ones, or the Argentina ones 20.88, and then sort of the two smaller mines, Peru and Bolivia, under $17. So that's very, very nice price, with sort of silver at about 31 now. And the gold side, the largest one in Brazil, is 11.95, all in sustaining cost. So that's very nice, with sort of gold at pushing 2,700, 2,650 now. It's a very profitable mine. They've got Chile at 1,300, and then Canada one, not doing quite so well, 1,900. Peru, couple in Peru at sort of 1,400 and 1,600, and then two smaller ones, one in Chile, not doing quite so well, one in Mexico, very profitable, 1,262. So yeah, 1,496 overall, and they sort of give their outlook, you know, the outlook for 2024. Obviously we're nearly at the end of 2024, so the guidance should be fairly firm, and they are saying like 22 million ounces of silver and sort of 950,000, I suppose, ounces of gold, which short of the target, but we'll see where we get to next year. And yeah, all in sustaining cost at sort of 17.25, which is pretty good compared to most of the other sort of miners that I've got. Most of those are slightly higher cost, and sort of like Equinox Gold at 1,900 company wide all in sustaining cost, where they're at say 1,525 for Pan American. So they're doing a little bit better. And yeah, sustaining capex, not really that high, I suppose, 300 million, and project capex at sort of 80 million. So yeah, as I say, they're in the sort of the more profitable side, and just taking the money. Hopefully we might start to see a little bit of sort of buybacks, or well, they have noted, I'm guessing they sort of did a little bit of buybacks. Shares outstanding at the end of the period down, what is that? I'm guessing these are in thousands, so 1.5 million shares. So yeah, a little bit of buybacks, but we might see that, and maybe start to see some dividends sort of next year. Coming on to economic news, we didn't really have all that much because it was Thanksgiving week, but got sort of jobless claims pretty much on target, up to 1.9 million, so it's not exactly what they would want, I suppose. Initial claims sort of slightly down, pretty much as expected. The low 200,000 is sort of where they want it to be, but I guess people that are losing their job are staying unemployed, with continuing going up. And then, yeah, Wednesday you had PCE numbers, core PCE 2.8%, not ideal, slightly up, and the non-core, including food and energy, up 0.2%, but that was expected, so I guess it's been baked in. And then preliminary CPI numbers for November for Europe. They sort of come out with it on the Friday before even the end of the month. And yeah, that was sort of 2.7% on core CPI and 2.3% on the headline. So that is up from 2%, but this was largely all expected. On the core side, slightly lower than expected. So portfolio-wise, as I say, not done sort of a huge amount, not done anything in the ISA side. I've got 2,700 quid still in cash, pondering sort of whether to maybe put that in Fresnillo on this sort of pullback. We haven't really got going yet on the silver, in my opinion. So with their sort of 55 million ounces a year, we're sort of fairly bullish on them. But yeah, not a lot else sort of happened in here. Not a huge amount happened on the Interactive Brokers side. Pan American, KGHM sort of now under 10,000. That's not doing all that well, sort of 9% up, but copper sort of having a bit of a rough time of it. Again, sort of fairly bullish on them with their high silver side. And yeah, the option side, I've sort of almost a rare week. I haven't bought any. Not really seen anything sort of particularly attractive, but we'll have to see. I'm sort of waiting for possibly a little dip in gold again, and maybe buy some January 2027 on the equinox. I'm not really sort of buying anything for end of next year anymore, or sort of January 2026, but yeah, I will sort of keep an eye on them. But yeah, sort of Hive and Riot are slightly up for the week. Equinox is sort of stayed where it was. Coeur Mining down slightly. Himax up slightly. Fortuna sort of stayed where it was. But yeah, it's not moved all that much. So yeah, interesting. Looking to sort of buy a little bit more in stocks. Obviously got 25,000 in cash, potentially a little bit more coming that way over the next few weeks if we sell out of a bit more crypto. So I will need to do some more stock research. Let me know if you got any suggestions, and leave your thoughts in the comments below. Like and subscribe. See you soon.